Hello everyone. Yeah, this week we continue with chapter 9. Chapter 9 is longer than the other chapters because I add some my own stuff into it. We will discuss options a lot more in depth. So that's why we will deal this week as well with chapter 9. It is going to be very interesting. I promise that. Anyway, let's talk briefly about arbitrage. That's what we start. This is going to be a very short video. Today or tomorrow I will post a longer video with introduction into um, options. That video is very important. I want that you guys pay good attention onto that video because it is going to be the base for the next classes, and it's kind of it needs attention to understand options, especially when it comes to be, for example, the seller of a put option and stuff like that, how the payoff looks and things like that. So it's important to pay attention there. So let's start with arbitrage. What an arbitrage is essentially if you buy something and sell it at the same time at a higher price. That is an arbitrage. So essentially, if you find price differences in different markets for one and the same thing, that thing would be like a stock, for example, or a bond. You can buy that stock in the one market and sell it immediately in the other market. Nowadays, with everything being electronic and so on and so forth, that is not a problem. So as you can think, you will not find really price differences in different markets nowadays because it's a very easy way to make money, very simple, especially with technology. So banks would use smallest price differences, like infinitesimally small price differences, to make money out of it, and they would just buy it where it's cheaper, sell it where it's more expensive, and they would make the arbitrage profit. Because of that, you will never, you don't usually observe price differences that make sense to do arbitrage. But back in the days, it was very different. Things were not computerized. You could, observe price differences and make an arbitrage profit. Anyway, because of arbitrage and because of, that we cannot see price differences, we can conclude that on the settlement or delivery date, the price of the future contract must equal the price of the underlying asset. Yeah, so that's one thing to remember. And then if that would not be the case, if the price of a specific bond would be higher in one market than in the other, as I mentioned, so the arbitrager can buy it at a low price and sell it at the high price. So he increases the demand in the low price and increases the supply where the price is higher. Accordingly, the price in the market where it's lower rises due to the higher demand, and the price in the market where the price is higher lowers due to the higher supply, and it continues that mechanism until the prices in the two markets are equal. Now, this slide is nice. It kind of sums up, the future prices. So the buyer of a future contract is called long position. Short position means you're selling a future contract, which means you profit from falling prices. So it can be used to speculate on falling prices in the market. The obligation of the buyer would be to buy the commodity or underlying. The obligation of the seller is to sell the underlying. So remember that here when we have future and forward contracts, it is an obligation on both parties to, for the buyer to buy and for the seller to sell that underlying. As you will see soon, when it comes to options, the buyer of an option has only, as the name says, the option, but not the obligation to buy. That's not the case with futures and forwards. You have the obligation, you have to buy it, no matter what the price is. So even if the current market price is a lot lower, so you're kind of buying it at an overpriced price, you have to buy it. You have no choice, essentially. That's why you have the margin accounts and type essentially deposit there. So oops, sorry about that. So who takes the long position in hedge? So it's either the user of the commodity or buyer of the asset who would be hurt if the price rises. Essentially, this way, if they are the buyer of a future contract, they know in advance at what price they will be able to buy it, or not only able but also obligated to buy it. And people who use it as a speculation, as I mentioned before, those people are on the buyer side of a future contract who speculate on a rising price. Now on the seller side is of course the opposite. Those people who are the producer of the commodity, they are usually on the seller side because they know as of today at which price they have to sell it, or they will sell it, so they can plan better for the future. They get rid of one fluctuating factor, one risk factor. And also those people who speculate on lower prices, those people would be the seller party of a future contract. So that's it about with forwards and futures. As I mentioned, next thing will be options. We will discuss it very thoroughly with option strategies. And yeah, the video will be uploaded either later today or tomorrow. Thank you very much.